Let's get across the market open now. Kyle Rodder joining us from capital.com. Kyle, happy Monday to you. Let's take a look at where we finished on Friday, broadly higher, in fact, reaching those record highs across global markets. Buoyed by what we're seeing, particularly in terms of trade negotiations, positives emerging apparently between the US and China, although not so Canada.
Yeah, well, the markets have certainly chosen to sort of accentuate the positive and eliminate the negative on that one. And to use another cliche, of course, the markets have kind of fully scaled that wall of worry now and back to levels that we saw pre the Liberation Day sell-off, or going into that sort of Liberation Day announcement. And there's nothing more bullish than a record high. So the markets are really sort of buying into this notion that trade deals are going to come before that July 9 deadline, and that most importantly, the relationship between the US and China, the most important trade relationship in the world, is moving in the right direction. Now, of course, the Chinese kind of watered down a little bit what the actual nature of this deal, as Trump suggested it was on Friday, that it's more of a sort of framework to discuss or execute a deal going forward, mostly about rare earths and technology transfer. But nevertheless, a lot of good news is more or less priced in. Arguably, it's a degree of complacency because a lot more has to happen in the space of a week and a half, one would suggest. But nevertheless, as I said before, it's a very bullish market. An S&P 500 breaking out to record highs says so, and we're now in a situation where we're looking at whether the market can sort of build on this particular rally. And I suspect that if we do get further trade developments and positive headlines, then this rally will continue.
Although, as I mentioned there's a breakdown in trade negotiation with Canada. Also, a bit of a dent on risk sentiment with Trump talking about the possibility of bombing Iran again.
Yeah, there seems to be a lot of hot rhetoric still in the Middle East in particular, and there's this, obviously tenuous and potentially, just simply tenuous ceasefire between Israel and Iran, and some still hot rhetoric coming from the Iranians about, I guess, the nature of the conflict going forward, as well as obviously again bellicosity from the Trump administration about intervening further with airstrikes, and on top of that, this kind of rhetoric of make Iran great again, which is sort of a nod to potential regime change. Now, clearly, if you look at the market's reaction to this news, they're kind of taking the kind of taco approach to it, which is the Trump always chickens out, I suppose, avenue, and not really pricing in a high degree of volatility, especially in the energy markets, which seem, much more stable than a week ago. Clearly, we've seen energy prices coming down significantly. But really, and as we've sort of spoken about in the past, is, kind of four key variables when it comes to this situation in the Middle East, specifically between Israel and Israel. Does it turn into a sort of a broader regional war? Does US intervention go from airstrikes to being something of, boots on the ground? Does Iran retaliate by trying to strangle the Strait of Hormuz? And, effectively, finally, is there kind of any prospect of regime change that could destabilize the region any further? Basically, the markets don't think that that's what the US is trying to achieve, that a lot of this rhetoric might be more appealing to Trump's base, or more or less keeping the Iranians on their toes. But of course, it's a very fraught situation. The ceasefire at different stages has looked a little bit precarious, so it's one that could still be a source of volatility, albeit despite the fact that markets are kind of looking past the geopolitical risk now and focusing more on trade negotiations. I'm not even getting to that point about obviously what's happened between the US and Canada, which is something of a breakdown. But again, another thing the markets are looking through, despite the fact that it could result in the US being at odds again with its biggest trading partner.
Kyle, also a focus on Trump's big, beautiful bill. It's passed another hurdle in the US Senate, so it's sort of getting closer to being passed there overall. But clearly concerns remain, not the least from the Democrats, of course, that this is going to add some $5 trillion to the US debt.
Yeah, and potential inflationary pressures, I do suggest, and the markets have been fairly settled if you look at sort of bond market activity, and generally speaking, despite inflation data on Friday night showing some signs of stickiness, possible re-anchoring, that we are in an environment that will probably see further upward pressure on yields, mostly because of the significant issuance that is probably going to have to come through or will come through, to fund these greater deficits, as well as markets discounting a greater risk premium because of the inflation volatility going forward as well. We've got basically tax cuts and spending coming through into the US economy still when inflation's in the high twos, and more or less the economy is at capacity. So it'll be sort of fascinating whether this starts to have an effect on well, not only economic fundamentals, because it's probably a little bit more of a medium term thing, but arguably it will give the US economy a bit of a sugar hit in the short term. But to what extent this will sort of feed through into further volatility in financial markets, as they have to price in perhaps a loss of faith or further loss of faith in US fiscal settings and US fiscal management, and that will have to potentially filter through to equity markets that will obviously have to react to higher risk-free rates. So it's one that, again, the markets are kind of looking through, more broadly speaking. It has been sort of put to one side and been sort of below, foreign policy and strategic policy in the United States, as well as trade policies being as a major concern. But effectively, it looks like it's the final hurdle for this big, beautiful bill to be passed. And again, it's likely inflationary. It certainly adds pressure on the bond market, and it's not something that the markets have been really responding to significantly for 3 or 4 weeks. And one suggests that perhaps it's a mispriced risk.
Just looking ahead this week, the focus in the States is certainly on jobs data, and we'll be on that locally. We've got a bit of data our way just in terms of retail trade and so on ahead of the RBA meeting next week.
Yeah, it'll be that non-farm payrolls print that I think will be the significant event risk for the week. And one interesting dynamic to point out is that despite these fears that inflation could be sticky, possibly re-anchored, added to because of fiscal policy in the United States, and on top of that, the data that we got on Friday night, only compounding all of that perhaps, and being, again, another thing that the markets have looked through, is that market participants are still pricing in rate cuts from the Fed going forward. And arguably a part of that's coming from a sort of a reframing that's occurred because of the summary of economic projections from the Fed a couple of weeks ago, which sort of suggested that it still expects to cut interest rates a couple of times before the end of the year, despite inflation ticking up to as high as 3% based on their forecasts. Explains why maybe some of these inflation fears are being kind of looked through. But another thing to just keep an eye out for is just some signs, very, very early signs, that maybe some weakness is filtering through the labour market. And that's what market participants are expecting this week on Friday, that we'll see a slower pace of job creation, that we'll see the unemployment rate tick up to 4.3%. And we've got the markets now pricing in somewhere around 20 to 25%, depending on the day, chance of a rate cut in July, certainly 2 cuts before the end of the year. And not only, just the Fed's, I suppose, nonchalance towards inflation, it's also maybe these fears that there is some weakness coming through the US economy. There is going to be some weakness emerging in the labour market fairly soon that will justify the US Federal Reserve to cut interest rates to protect the labour market. So I think it should be really, really interesting, because clearly growth and employment is still where the policymakers' focus lies. It would appear that the markets are also focusing in the same sort of direction. So this jobs data, then following going into earnings in the next couple of weeks, will be the really big kind of fundamental risk that we'll be talking about, calendar event sort of a risk, adjacent to, of course, this sort of July 9 deadline that we're getting very, very close to when it comes to these trade deals, US trade policy.